All right, so I want to talk about two different things right now. When you are in a position and you want to produce income, selling covered calls is one of the most predominant ways to do that, but it's not smart to do in every market trend. The markets theoretically they trend half the time up or down, and then they go sideways half the time. Okay, we're looking at APLD here. This is Applied Digital. I do have a position on this name. This is a active LEAPS letter trade, and I am a believer based on this long-term price pattern that we're seeing that it's going to break out of 40 and trade up to the 50s and 60s, presumably by the end of the year. I like this volume spike that's happened. There's been some positive news catalysts, and there's a lot of ways to trade it. But before I talk about trading, I want to talk to you about covered calls. This past month in April, I probably left $50 to $100,000 on the table from covered calls that cut off my upside. So lesson number one, do not sell covered calls in all market trends. When the market's trending, sideways or down, great, love it. Do it all the time. Rinse and repeat. When you have technical indicators with volume behind it that we're in an uptrending market like we have been in the last several weeks, selling covered calls is going to be a painful caveat in your portfolio because you're going to be capping your upside. So I've been dealing with that, and I actually have that on this position. I have 1,000 shares around 25, 26. I sold the 32 and the 35 calls, and now the stock's at 36. So I've had to pay a little bit, not a lot, but a small debit to roll out a month and roll up. So I'm continuing to increase my upside. So that is the strategy that you do it, unless you take the loss on those covered calls and buy them back and stay fully long. With APLD now, so I'm in the position, I have covered calls sold. What do? Well, you can continue to add more long exposure by buying shares or adding call spreads or buying calls or whatever the strategy is. But for right now, I want to go and price out for you the January. I'm going to go out to the furthest expiration. And like when I look at stocks like MRVL and AAOI and Creda, like all these like AI infrastructure stocks that have literally gone up 50% in a month, the options, long-term options that are 50% or up to 80% out of the money have gone up literally 1,000% in the last month. I'm not kidding you. APLD, I feel like, has the characteristics. It hasn't had the moves that the other names have had. However, pricing out the options for January 2028, they're expensive, and the market makers are scared. So the 60s are as far as you can go. I can't even buy a 100% out of the money call. So I don't like that. What I would do is I would price out the January 2027s first and get a comparison. And you can see they're still very rich. So this is a really interesting name to trade. They're making it hard. So the market makers, when they're scared of stocks like APOD that could go up 300% in the next year or so and kind of carry suit with all these other infrastructure plays, they don't give you the ability to buy these far out of the money calls. So you can make it into a call. There's only a couple things you can do. You can make it into a call spread, or you just have to pay it. So the 60 strike calls, which are expensive for this year or January 2027, are $9.30, roughly mid price, $9.50. I don't love it. I mean, I like buying cheap options that are 50 or 100% out of the money, and buying an option for almost $1,000 contract is not considered cheap. What I would do though is I would continue on the same thesis that I have now, is own the shares and then buy close to the money calls, like the 25s or $2,000 or the 30s, but staying somewhere near the money is a smarter play. And if we were going to price out the 50-60 call spread for January, which you can see is $1, that is an attractive risk reward, but it's going to take them a year and a half to almost 2 years for this to materialize. So you have to start asking yourself questions like, are you okay with tying up, let's just say on 100 contracts? So on 100 contracts, buying the 50 calls for January 2028 and then selling the 60s, I like this trade more, especially if I can get filled at mid price around $1.25. That means I'm risking $12,500 roughly. So risking $12,000 to make $88,000 roughly is the math. That's the way that you can trade asymmetric upside while navigating through a complex options chain. This is more advanced stuff. If you want to learn more, if you want to get involved, head over to Option Trading Coach. Get the Vault. The Vault is my universe of pre-vetted names that are optionable. And then take it a step further and try out the LEAPS letter. The LEAPS letter is where I am actually doing these trades, managing them, teaching people how to understand what's going on, and at the end of the day, grow your portfolio. That compounds over time. So that's all I got for you. I'll see you in the next video. Have a wonderful rest of your day, and we'll be in touch.